All right, so we will give this a second. We will see. So when Kyle and I tried this just last Friday, it did not work well. So fingers crossed that we are actually going to be able to do something here and it's actually going to end up working. And actually, let me make sure I turn off my volume as well. Yeah, so my volume is off. So we'll see if this actually ends up working. It comes through. You guys will have to let me know if it does. Um, hopefully things look pretty good on your guys' end. And just wanted to do a quick stream on this one. So I am obviously back in the States for those of you guys that have been keeping up with the other channel. We do a little bit of live streaming over there. So if you guys are interested, the link should be in the description of this video. But as always, I try to want to keep up with you guys at least once a month with what's going on the MattMoney channel from a live stream perspective, do a Q&A, see what's going on in your guys' lives. So hopefully it looks like it's coming through and not really getting buggy. But if it ends up being buggy, let me know in the chat. So I'm watching the chat on my monitor here to the right. So if it's getting buggy, just let me know. And I might just have to wait till I get internet tomorrow. So internet's coming in tomorrow. So then I could just wait until tomorrow night to be able to do something like this. So if anybody could let me know if I'm coming in choppy or what, that would be extremely helpful. But for those of you guys that don't know, me and Kyle have been doing obviously a little bit of a passive income educator, website. And with that, tomorrow we're actually going to be doing, or sorry, not tomorrow, but Tuesday, we're actually going to be doing a private live stream specifically for options trading. So if you guys have seen, if you guys follow me on Instagram, or if you guys follow me on just, I guess, my normal monthly updates, you'll see that I've been making some pretty decent income kind of coming from the portfolio in terms of options trading. And a lot of that is doing covered calls and cash secured puts. And so that's been going relatively well. We've been trying to convince Kyle to get on the boat. Dave got me on the boat. I really enjoy it. I think it's a great opportunity for folks to get a little bit of extra income, especially that it is kind of a known risk that you're kind of entering into each trade. So you're always going to get income. And if you kind of know what you're doing, you're not going to, I guess, lose your shirt like you can in some particular options trades, like naked calls, selling naked calls or anything like that. So we try to do something a little bit less risky, but get yourself some additional income. So anyway, would really love some questions kind of coming in. Just wanted to check in with you guys. Hopefully it's coming through, not choppy. So if anybody that is watching, let me know, would know, I guess if it's being choppy, just let me know. But anyway, so we do have an interesting comment here. Do I have a girlfriend? The answer to that is no. I came back to Trinidad, or came back from Trinidad about a week and a half ago. And yeah, so I want to figure out a way. You probably can't see it all too well. Maybe if I get out of the picture, ignore all the trash because I am still moving in. But let's see if it'll focus in. Man, I want to get a camera that allows me to really like focus in on the background and the actual. Let's see if I turn off this light. Will it help? Not really. But I really want to get a camera that will be able to have the city line in the background with me. So that way you can see my gorgeous face, then of course have the background behind me. Of course, I'm going to order some things to hang up on the walls over here and here. Obviously still need to get outdoor furniture, a couch as well. I also need a desk, which I plan on putting a desk right to that little corner there. And I think what it's going to end up being is, so that way you kind of have a backdrop and I could potentially put some things on this wall. So that's the hope. And hopefully you guys can hear me a lot better now. So I got some AirPods. I'm getting my Bruce Wang on, you know? That's basically all that I've been trying to do is get a little bit of better audio quality, but also want to get the video quality up for you guys as well. So anyway, let's just see. So let's just jump through some of these. We have some interesting commentary coming in here. I welcome that, Um, to answer Leslie's question, I would not do an OnlyFans, but you can contribute to me, obviously using that little money sign down below. I don't object to anybody doing that. But yes, everybody's congratulating me on the new place. I really enjoy the new place. It's a really sweet place. Hopefully sometime soon, give you guys a better tour once I get some more artwork and couches and stuff in the apartment. But basically have everything I need to live. I don't really watch a lot of TV, but I bought a TV, as you can see. What is it? Yeah, right there. So I still need to get a stand for that as well. I don't know if I'm going to hang it on the wall. I don't really know if I do those sorts of things. But anyway, let's hop right into some of these questions, because that's really why we're here. So our boy Scott asks why ITOT instead of VTI. The reason why I do ITOT is just because it's a Fidelity sort of partnered product, and it also has about 150 more stocks in it, or companies in it, than VTI does. I think both are great products. If you compare them, obviously VTI has a lot more assets under management. I don't have the numbers off the top of my head, but I wouldn't be surprised if it's in the couple hundred billion at this point. SPY is, I think, the best has the highest assets under management, but I think VTI is a close second to them, if not maybe a VOO, which is the Vanguard S&P 500 index. But VTI, I think, is a high quality product, so that has 3,500 stocks in it. So it includes the S&P 500 stocks, and then it includes a bunch of mid cap stocks and a bunch of small cap stocks in there as well. But the reason why I wanted to do ITOT is it includes another 100, 150 stocks. So it goes to 3,600 stocks. So that includes a little bit smaller micro caps in there as well. So I didn't want to leave those out. But of course, I think if you look at the performance of VTI, it does slightly do better. But I've seen some of these smaller companies now, like these smaller technology companies, run up very much. But anyway, it's kind of a wash, to be honest. But I think the performance of VTI historically has been better, but I don't want to neglect any micro caps. So anyway, that's probably not a good answer, but I think VTI might be a superior product, to be honest. But for some reason, I just want to do ITOT, and I think that I think eventually, once I get a couple hundred shares of it, I might start rolling it into a separate account in my Fidelity so I can do options, because obviously M1 Finance, you can't do any options, right? So anyway, so there's that. So hopefully that one helps you there. Let's see. What puts am I selling this week? That's a good question, man. Let's see. I have a lot of puts on at the moment. So I have about 3 contracts of Beyond Meat at about 140 bucks. So $40 strike price. So that's just under $45,000. So I'd have to close out some of those. So I got to wait for those to either get closed out or whatnot. And I think I have a Tesla that I put on at 325. So I did have some smaller contracts this week kind of come off, and I was able to keep the premium. AT&T was one. JP Morgan was one. So there's 9,800 bucks that I kind of have cleared there. It was Caterpillar one, I think. And Johnson, no, it was JP Morgan and Caterpillar. I was thinking if I did one for Johnson & Johnson, I think I just sold one from Johnson & Johnson for this week, which will be nice to be able to hopefully get that. But the nice thing about that I want to do, what was it for Johnson & Johnson, was it Johnson & Johnson? Who else? I think it's like Johnson & Johnson and Verizon. So right now they're kind of at their tip of their 52-week range, right? And so I'm like, well, it makes it a little bit easier knowing and selling covered calls if you're like, well, the strike price that I'm selling at will be outside of its 52-week high. So that company obviously has to break into all-time highs, which with the current environment that we're in, it's a little bit interesting to be thinking that that will be hitting 52-week highs in some of these companies. But Johnson & Johnson always trades at a premium. It's always a good company. A lot of people like it. And Verizon always does relatively well as well. So anyway, Looks like I need some mods. Yeah, I need some mods, man. Yeah, Matt. Oh yeah. So quick story on that. So Pelt Work, my boy Scott, who's a member of the WhatsApp group. He also joined us on the live stream on Friday. And after my phone died, so we went about an hour, 10, hour and 15. For some reason, man, on Fridays I just like use my phone too much, I guess, and I just never charge it. So I always end up dying, and I need to figure it out. Now that I have these AirPods, actually, it'll help because I actually have the phone plugged in and charging at the moment. So hopefully in the future, we don't have that problem because I kind of have it set up on a little stand and it's plugged in and charging. And then you guys can obviously hear me. And I assume you can hear me through the AirPods. I hope it's not just going through the iPhone mic. So if the quality of the sound sounds better, of course there's echo because there's no furniture in here. But if it sounds better, let me know because obviously I spent a good chunk of change, probably almost as much as I make on YouTube in a month to buy these headphones to get a little bit better quality for you guys. So let me know if it helps compared to what it sounds like normally, or if it's about the same. But I think definitely when you get to the videos that I'll be, I guess, doing in the future, recording. I was actually thinking about doing a video instead of the stream, but I wanted to see what the stream was like. But anyway, yeah. So after my phone died on Friday, I plugged it back in. I laid back down, and yeah, I was in my boxers at that point. I was like, my phone's dead. Everybody's, the stream's off, whatever. And I hopped back on, and Scott, Dave, and Kyle were still talking. And I guess Scott got a little glimpse of like the chest up, and I wasn't wearing a shirt, and he thought he was gonna have to start dropping some dollar bills in the background. So luckily, I think he got more than he bargained for. He's like, man, Matt, I didn't think of becoming a member. I was subscribing to your OnlyFans, but it is what it is, man. Um, so yeah, that's pretty funny. So we have a good question here. So what's my age and how hard was the first 100,000? So I'm 29. So I think some of you guys may or may not know. So closing in on $600,000 under management. I think if you were to consider the websites and stuff, it's over 600 at this point. But in terms of the actual portfolio, I think we're up to like 565. So hopefully be able to get above 600,000 in the next 2 months. But I mean, that's probably wishful thinking and require a little bit of a rally in the markets. But you never know. Christmas always brings a Christmas rally. So maybe, but I think more goal for me would probably be 750,000 by the end of 2021 would be the real goal in terms of value of the portfolio. The real thing for me is the dividend income that comes from the portfolio. So I don't really look at things. I've started now to kind of look at things as more of like a portfolio value as I've started to move money around a little bit more strategically. So when I was first getting into the portfolio, I was all mostly about dividend income. Now that I'm trying to move money around to here, do websites, potentially get into physical real estate, aside from say Fundrise and Cardone Capital, I have started to look a little bit more on the actual capital that I have in the portfolio. And so I do have a lot of capital that's kind of sitting idle in my 401k, we'll say. And I plan on potentially rolling that over to a rollover IRA while I'm employed. I have that opportunity and see what I can pull out in terms of contributions. And with that contributions, I might start getting into physical real estate. But anyway, so that would be fun because that adds a little bit more leverage to the portfolio. And I don't feel uncomfortable with that because I have the other cash flow streams kind of coming in, a couple $1,000s a month. So if a tenant leaves, and it's a $250,000 house, I have the cash flow coming in from that portfolio. The only problem then is if I do unfortunately lose my job or want to retire, that kind of puts a strain on things because obviously I would want to use that to pay bills if I were to say retire and go to age or something like that. But anyway, how hard was the first 100K? It was really hard to get to the first 25 and 50,000. And then once I got to the first 100,000, I didn't really blink an eye because I think it just happened so quickly. And so I do have a high income, so I'm not going to downplay that. So it's easier probably for me than most people, but it's not to say that I had to work hard to get there, right? So a lot of nights in the library and stuff like that to be able to get where I'm at today. Um, but yeah, I would say 100,000 was tough. 200,000 I remember pretty vividly. Actually, it wasn't that long ago, and then it just has started ballooning real wild here over the past year and a half. Where I think when I went to Trinidad, I was a little bit under 300,000, and that was about a year ago. And so now we're closing in on 600,000. And I think a lot of that has to do with the amount of capital I invested back in March. I think a lot of it has to do with the diligence of me trying to save as much money as I can. I think part of it also was the fact that I didn't have an apartment to rent or anything like that. I was living on the company dime for a little bit. So a lot of that is going to hit me. And then this month, there's going to be a lot of cash outflow. In the month of October, I had to get a new car. I'm obviously now back in an apartment. I had to get new furniture. I got rid of all that stuff when I moved to Trinidad. So um, anyway, so cool. So thanks, Scott. Yeah, I'm curious. Okay, yeah, I'm curious. I was curious how the echoing and everything like that, but I was actually surprised. So these are the big dogs. These are like the $200 um, AirPods or whatever, and they have like noise canceling and stuff like that. And so I was like sitting in my car after I picked them up, and I was like, I wonder how good these are. You just have white noise in the car, just kind of idling or whatever. And so I didn't notice it at first. I kind of put it in like the one ear, and I was just like, this noise canceling sucks. And then I put it in the other ear, and then I think it like turned on. I was like, oh shit! And I was like, I can't hear anything. I can't hear the air conditioning. I can't. So I was like relatively well surprised by that. So really good product. I mean, I still don't know if I would charge $200 for them, but um, anyway, as long as people don't continue to complain about the noise, because I think, or not the noise, the audio quality, because I think a lot of people don't subscribe because of that, which is actually kind of sad. I think sometimes people more so subscribe for the production quality rather than the message of what is coming out of somebody's mouth. So it's pretty sad. So I mean, if I had a Bruce Wayne set up or a Graham Stephan set up, I feel like I would probably be a couple 100,000 subscribers at this point because my message is pretty much on point. But anyway, maybe I'm not as articulate as a Graham or Bruce. Bruce is pretty good as well, but not putting them down either. They have really good setups, and they obviously have pretty good content as well. So not putting them down. I think they have great product, but I just haven't had that time to put in the production quality that they have. So I think over the next couple of weeks I will be doing that, and hopefully it pays off in the long run. So a good one. How is your performance compared to VOO? So I love this question, and I've answered it a couple times on a different on our streaming channel a good bit, and I talk a good bit about it in our WhatsApp group. So if you guys are interested in joining our WhatsApp group, just send me a message on Instagram, man, and I can easily send you the link. And I'll just type in what my Instagram is here. So if you guys are interested, feel free to hop on over to that and message me, ask me questions. That's why I'm here. We can get you into the WhatsApp group. And that's obviously free. So no cost to you guys. I just want to be able to help as many people as we can in there. So, but specifically, what was the question? Oh, my performance against VOO. So I wasn't, oh, my man, Uncle Jason, living the dream, brother. How you been? So yeah, stateside for now, I guess, until November. Company's doing restructuring, so I guess we'll never know, right? But if I do get the boot, I'll just move to Asia, so it won't be stateside for long. But I think I'll be okay. But you never know when you have large layoffs like this. So that's part of the reason why I'm going to answer the question that I am going to answer the way I am. So somebody asked my comparison and my performance against VOO, and exactly for the reason I just stated. I work in a pretty volatile industry. So for those of you guys who don't know, the skyline behind me is Houston, Texas, and I work in the oil and gas industry. So it's pretty volatile, a lot of layoffs, and And so I've been experiencing layoffs since 2014, 2015, 2016. Saw some, I think, in 2017-ish as well. And so I've been luckily not had any over the past couple of years. And I was actually fortunate to go on assignment in Trinidad, which was absolutely phenomenal and a great experience for me. And I wouldn't have traded that for the world. And I miss my friends dearly. And I definitely expect to go back down there. And I still talk to a lot of them pretty regularly. I miss them a good bit. But anyway, it's different, and I love the U.S. as well, and it's nice to be back in Houston. I loved Houston. For some reason, I wasn't that upset about leaving, but now that I'm back in Houston, I'm surprised. I really love Houston. It's not that I didn't love it before, but anyway, the way I'm going to answer this question is probably a little bit interesting. So because of the layoffs and stuff that I was experiencing very early on in my career, I decided that dividend income was probably the way that I wanted to go. And I didn't necessarily care about total return. I cared about making sure that I had dividend income coming in. In the case of that, I did unfortunately get laid off. And so right now, looking at 2020, I should be having around $29,000 kind of coming in through dividends and other income sources that we've kind of got up and running off the ground. So that was kind of the goal, is to make sure that I was able to kind of build those sources up. So if I ever needed them and I were to get laid off, I could take whatever severance I got and then put that into the portfolio as well, and be able to generate that income and be able to either figure my own self out, or at least cushion some of the blow and get some of that cash flow kind of coming in. So that was the main reason for doing a lot of the investing that I did early on. And now that I've gotten a little bit closer to meeting a lot of my main expenses, because of course I classify my expenses of one of two ways. I have my necessities, like my living, stuff like that. And then I have like my, I guess, luxuries, right? My needs versus my wants. And all I really cared about was making sure that my needs were met, which I would consider in the $2,500 to $3,000, maybe $4,000 a month range. And I live pretty well, right? So can't complain in that respect at all. Then there's the wants, which I would say is like $1,000 to $2,000 a month. So if my kind of goal to be like financially independent was the $4,000 to $5,000 a month mark, to give me a little cushion as well, because obviously there's taxes and stuff like that. But once I got to that $4,000 to $5,000 a month mark, I figured, then I could start focusing on, getting back to growth. But I've noticed now that if I were to say get a severance or something like that, the amount of money that I would get from that, and I could invest that, and I'd probably be able to live pretty comfortably in the U.S. utilizing that sort of dividend income that would be generated from that additional severance that I would be able to get. And so I got a little bit less concerned over the past year and a half, or sorry, not year and a half, but probably a year to 6 months ago, and recognized that my underperformance in the market comparatively to VOO has been, I don't want to say significant, but enough where I now want to start focusing on getting the portfolio to a part where, yes, I still want that drip. Like, I love dividends more than anything. Oh, that's kind of cool. Now that it's kind of like getting darker out, you can kind of sort of see the skyline a little bit better. So let me do a little bit of that. That's kind of cool. So now that the dividends are still coming in, and I'm 29, I'm still young, I want to make sure that I'm investing in my ITOT/VTI. They're very similar with respect to what they're investing in QQQ, and I want to get a little bit of money coming from QYLD as well. And so I love my individual stocks, and I'm much easier to say invest $10,000 in an individual stock like MO or something like that than for me to say do that for an SPY or an IVV or a VTI, or I don't know why, but maybe it's because I'm just been so used to it over the past couple of years. But I've really started to try to shift and automate some of that. So I've gone from, say, doing $1,500 a month in my brokerage account to switching that to $1,000 a month, twice a month. So $500 in the middle of the month, $500 at the end of the month. and I moved a lot of the money that I was moving into the brokerage account into my M1 Finance account, which is also a brokerage, but I like to consider that my M1 Finance. And so I do the M1 Finance. I do 1,000 twice a month, so that's $2,000 in total. So I lowered the amount I was entering into the brokerage, moved a lot of it over to M1 Finance, and a lot of that is going into, like I mentioned, ITOT, QILD, and QQQ. So I've fully invested in my QILD. So all the money now will be going into ITOT and QQQ until they get filled up. So I think they're both sitting at 20% of the portfolio. And I have some leftover positions in Johnson & Johnson, Visa, and 3M. So I don't want to sell them. They're like 3,000 a piece. And I'm just going to let them kind of hang out because, they'll eventually get small, but smaller comparatively to, I guess, the investments that I'm doing. So it's about 41%, 42% in VTI, 41, 42% in QQQ, and then 14-ish% in QILD. And then the remainder is in 1% of Johnson & Johnson, 1% Visa, 1% 3M for the M1 Finance account. And so that's what I'm kind of going forward and hoping to kind of grow that too. So I think I don't have it up here because I'm working off my phone right now. By tomorrow, I'll be able to start doing multitasking, being on my phone and recording, obviously, streaming, and getting some of the sheets and stuff and being able to share screen and all that. But not today because I'm working off my phone. I don't want anything to crash. So, but yeah, what was I going to say there? So to answer your question, I mean, I'm definitely underperforming the market, and that's something I've been cognizant of in the past couple of years. But I think a lot of it was due to my circumstances and what I was willing to do in terms of what my objectives were at the time. Now that my objectives have somewhat changed, now I'm more looking at a total portfolio growth and potentially getting into real estate and stuff like that. I'm focusing more on getting the capital and the nest egg as big as it can, while also utilizing the drip to help get that cash flow stability and be able to use that as flexibility where I need it to be. So maybe earlier on the stream I mentioned, if I were to buy, let's say, a single family residence and rent it out, and somebody were to say move out, I don't have somebody paying that rent for me to help cover the cost of the mortgage, then I have the ability to now use the dividends kind of coming from the portfolio to kind of offset it, right? Like I probably wouldn't take the dividends out of the portfolio, but in the grand scheme of things, in the cash register, right? Like the MattMoney cash register, like the business that is Matt, I'd still have the $1,500 to $2,000 coming in from dividends, and let's just say $1,000 going out to the mortgage. Most of the time, the mortgage would be covered by rent, so I wouldn't have to do that. But in the grand scheme of things, I still have the $1,000 to $2,000, $1,500 to $2,000 coming in from dividends. If somebody wasn't paying that rent because they moved out, I have that not kind of as a cash outflow anymore, right? It's still covered under income sources that I'm getting passively through dividend income. And that's not including any YouTube or options or anything like that, which we've started to incorporate as well. So I know it was a really long answer for you, but hopefully it helped. But what I mostly want to summarize that statement by is it's not necessarily about outperforming VOO or matching VOO. It's about what your objectives are, to me. And a really good, so if you watch Graham Stephan's interview with Kevin O'Leary, I think this is really important. And you'll kind of see that why he doesn't care that he doesn't beat the market or match the market even. And basically the gist and the summarization of what Kevin was saying is he's already made his money, right? He's made $4.2 billion off the sale of his one company, which he walked away with hundreds of millions of dollars, if not billions of dollars, by doing so. So he doesn't necessarily care if he beats the market. What he cares about is making sure that he has capital preservation and that he doesn't go down 20, 30% like we saw in the March timeframe that the S&P 500 did. And he cares that he's able to say only go down by 5% or 0%. And so, he's a prime example of, why sometimes the world gets crap for saying hedge fund managers, 90% of the hedge fund managers never beat the market. And it's like, well, sometimes that's because they don't want to beat the market. They want to make sure that they have an average, say, 6 or 7% return versus the 8 or 9% return the S&P might have. But they're using that extra percentages that they might be getting to purchase derivatives that will be able to help offset in any sort of losses. So they might say, well, let's buy some put options against the S&P next 2-3 months out. So in case anything happens, we can guarantee that our clients won't lose any money. So it's a little bit less about gaining as much as you can with those volatility in between, rather than helping preserve capital and just making sure that it's good for generational wealth. So it's very dependent upon where you are in your investing cycle, right? If there was a one-size-fits-all strategy, it would have been found out by this point, and people would, obviously be selling it. But I think the problem is that there's so many different views on how you can utilize the market. You can trade options, you can buy stocks, you can buy ETFs, and there's so many different ways, right? I mean, you could try to do getting rich quick. You could try, your path of getting rich carefully by investing in ETFs. You can try options, and so it is what you want to make of it, and what fits for you. And we talk about this all the time on the Passive Income Educator live streams. It's the 5 things: your objective, time horizon, risk tolerance, how much capital you're adding consistently to the portfolio, because that'll change what you do on a day-to-day basis, and how active or passive you want to be in your investments. And if you kind of answer those 5 questions for yourself, you might be able to change your investing strategy for the better. And so really, really bad way to answer your question. But hopefully gives you an insight as to why I don't care that I didn't beat the market over the past couple months or years even. I did what I thought I needed to do to be able to get that income in case I needed it. So that's the answer. So yeah, Ron, let me scroll up. I forgot your question here. What are my energy allocations between pure oil? Oh, I don't have that off the top of my head. Yeah, I don't have that off the top of my head. And it's very hard to quantify because I don't invest in pure wind or pure solar companies. So I invest in BP and Shell and Exxon and BP Midstream Partners and CQP, which is Cheniere Energy Partners. Try to think if there's any other energy companies. Oh, I have a small position in Cosmos Energy as well. I would say the most of that is oil and natural gas. And but within there, BP and Shell do have wind and solar and other electric utility sort of businesses as well. So to give a split, yeah, I don't know, but hopefully that helps answer the question. I know it's not really a pure answer to your question, but the second part of it is, if Biden wins, this is good for green energy. So just wondered my opinion. Well, I think that I think what BP and Shell are doing, and I can't touch too much on it because of the position that I'm in with my 9 to 5, and I don't want to give out too much information, but I like oil and gas, but I think that there's been phenomenal margin increases in renewables that it's actually become to the point where it's actually somewhat economic. And so even if you were to say not have some of the incentives from, say, local governments, you'll be able to actually make some money, low teens or high single digit sort of returns, and consistent as well, very reliable sources. Whereas in the past, you weren't able to get that. But I think another really good one is, if you really are curious about this one and where everything is heading, look at one of NextEra Energy's previous quarterly earnings reports. They talk a lot about how since 2012 to 2013 timeframe to now, the efficiencies and the costs per watt for wind and solar have gotten better by 10 to 15% every single year. So the cost comes down 10 to 15%, and the efficiency goes up 10 to 15%. So it just goes to show you that at this point, yes, it might not necessarily still be as economic to do renewables versus, say, typical oil and gas. But at the end of the day, it's going to get to the point where it starts increasing, exponentially better to do renewables. And not only is it a cleaner source of energy, it's carbonless, it's sustainable because it's renewable, right? And it's a lot more consistent. So it's a lot more man-made, right? And yes, we're harnessing Mother Nature's God-given energy, right, for our benefit. But a lot of times what ends up happening is you have the volatility of oil and gas isn't necessarily just in the oil price, but it's the fact that you can't see some of the rocks. I mean, the rocks are several thousand feet or sometimes several miles below the Earth's surface, and so you're using some of these interpolations. So you see the city behind me, which is Houston. There's a bunch of outer highways in Houston, but one of the fields I was working on, I won't say which one, in the Gulf of Mexico, actually had a pretty big wingspan aerially. So it would be as big, the field would be as big as where I'm sitting today and right now to the skyline, even further past those skylines and skyscrapers, probably about 2 to 3 miles, no, probably longer than that, 5, 6 miles west of that, and maybe a little couple miles east of the skyline as well. And it's pretty big aerial extent in that respect. It covered about, I would say, the main portion of it covered about easily 6 Gulf of Mexico lease blocks, and each Gulf of Mexico lease block is 3 miles by 3 miles. So the aerial extent was probably, I won't say how much, but because I don't really remember off the top of my head, but I would probably say 30 square miles. I mean, pretty easily, right? I mean, you're talking 2 to 3 lease blocks up, which is 6 miles, or 6 or 9 miles, and then 2 to 3 lease blocks, wide, which is another 6 to 9 miles. So, I mean, it's pretty substantial. Of course, they didn't entirely fill every lease block because sometimes there's a stratigraphic boundaries and stuff like that, but easily 30 square miles of land, which you are then drilling a hole that is, say, 5, 6 inches around and trying to investigate what it's like for 30 square miles. So you drill your first hole, which is this big, and try to interpolate how much oil and gas is there in 30 square miles. And it's difficult, right? You have, let's say, 200 feet of rock that you're trying to drill through. You get one little core, and you say, okay, this is potentially what it looks like for 30 square miles. And then you also not just say square miles, but try to understand what the shape of it is. Where does it pinch out? Where do the strategic ends to this reservoir? What's the depositional environment look like? And back when these sands were deposited, where was the sand being deposited from? Is it going to get thicker to that section? Is it going to get, I guess, thinner to that section? Is there going to be shales that are kind of laminating in? A whole bunch of different things, and the variability and assumptions that you make off this 6-inch hole out of a 30, let's just say, square mile sort of field is absolutely mind-boggling. Then you drill a second hole, and you're like, well, all the assumptions we just made about when we drilled the first hole just went out the window because now we have 2 holes, 2 pieces of data, and they're either the exact same or completely different. But what you did is you made a bunch of assumptions when you drill the first hole, then you drill the second hole, then you have another, let's say, piece of information, and you're like, well, that completely changed everything, or made it bigger, smaller, or it was wet, meaning like there's some sort of fault compartment in there that makes it like water filled rather than oil filled. So, I mean, that's the sort of stuff that you are dealing with. And that's why you sometimes see like some of these companies spend 200, $300 million trying to drill some of these wells and explore and end up with zero revenue. Whereas, and let's just say though, you do find something like what I was working on. It's been massively profitable for the organization that I work for. But I won't say how big it is because that might give you guys an idea as to who I'm working for. But regardless, those sorts of things come up. But you have to think you have to pay for all the other failures that have been drilled and didn't come up with anything. And so, yes, the return on that project, let's just say, is 30% rate of return, but you made 0% and actually a negative rate of return on, say, 3 or 4 other different prospects that you had. So now that you have this new prospect, it'll be able to help pay for everything else and then some. So that doesn't really happen as much in renewables, right? You kind of have a steady income stream. You're like, okay, we know what the sun patterns look like here. It's been measured for thousands of years in this particular location. We know exactly what the efficiency is and the how quickly the efficiency of the, let's just say, solar panel dies over time. We'll lose 1% of the efficiency every single year. You kind of multiply that out and you're like, okay, well, we'll have to replace it X, Y, and Z amount of time. Like you're dealing with equipment on the surface, on land, not something that's, say, 2 to 3 miles underground, or let's just say where I was working in the Gulf of Mexico, 2 to 3 miles of water, and then a couple miles further down of maybe not 2 to 3 miles of water, but 1 to 2 miles of water rather, and another mile or two down, below the mud line once you hit the ocean bottom floor. So it's a little bit different, and still obviously the same goal, right? To make people have the energy that they need to get to where they're going, make sure that they have the ability to heat their homes, power their cars so they could go to one spot to the next, power their businesses, cook, have gas to fire up and have dinner every single night, to make roads that we can drive on, to make shoes, to make everything that we use a lot on a day-to-day basis. Some of those were specifically highlighting oil and gas. Some of those were specifically highlighting just energy in general and why we're in the energy industry as a whole. So I personally look at myself as, somebody that is working for energy, trying to make sure that people get the energy that they need. Yes, I studied and have a background in petroleum engineering, but at the end of the day, I'm here to help people. That's what I think I was born to do, is to help people. And I do that hopefully through the YouTube channel. I hopefully do that through my 9-to-5 job. And as long as I'm able to help provide people with energy, that's why I'm in the industry. So anyway, very off topic and a bunch of tangents in there, but hopefully helpful, and hopefully gives you an idea as to what I think. And unfortunately, it didn't answer at all your question, Ron, because obviously you're asking about my percentage splits, but the answer is I don't know. But hopefully that gives you an idea as to life with Matt, I guess. I have no idea. So let's see. Okay, so there's another one. How do you decide whether to sell 2 to 3 puts for 1 week versus 1 year for, say, AT&T at $28? So generally speaking, 1 year you'll get more premium up front. But the way that I like to look at it is so much things can happen in a year's time. But if you were to, say, be able to sell 50 or 30 1-week calls, you'll make a lot more money than I think you would in a year's time. So it's very dependent, and it's very difficult to be able to estimate what can happen in the markets over the course of a year. It's a lot easier to try to say, okay, within a week's time, I don't think the stock will move 10 to 15%. So if I sell a put, I think that I'll be okay. And that's generally speaking been the case for me. I generally will look for something that is 5% likelihood of being in the money at expiration. And with that, I generally say get 10 to 15% out of the money from where the strike or the current price is. Rather, the strike is 10 to 15% out of the money from where the current price is. So for AT&T, I feel a little bit more comfortable selling it at like $28, $27, which is within 10% of AT&T. But that's just because I have a firm belief that it really shouldn't be that less valued than $28. So anyway, hopefully that helps. But over time, it requires more work, of course, a weekly basis and managing capital and all that. But say what ends up happening is, you sell something at $28. Let's say you're able to get a couple dollars for it, $1, maybe $2. Whereas if you were to, say, be able to do $28 a week out, 2 weeks out, you might get $16 or $20 maybe if you're lucky. So if you're able to do that, let's just say 30 times in a year, you're going to make a lot more money overall. But Any way to get the link without Instagram? Yeah, man. Just like leave me a comment on one of my videos. Sorry, I think Drizzle is talking specifically about getting a link to the WhatsApp group where we chat a good bit. It's like 24/7. We got people from Kuwait in there. We got people from Canada. A lot of people from Canada. So if you're Canadian, you know, we got the whole Rio Can gang in there as well. But a lot of folks in there. Obviously, I was talking from. So we still have people in Trinidad and Tobago. I have 2 or 3 coworkers that I got in there. I obviously was living in Trinidad and Tobago at that point, so I was in there. But now I'm back in the States. So, let's just see. So, but CDP, yeah. I mean, if sorry to kind of go back. So yeah, but sorry, back to Drizzle. Any way to get the WhatsApp group without messaging me on Instagram? Yes, message me on a comment on one of my videos or something like that, and I will do that. But CDP, back to your question about like because you asked kind of a follow up or something like that about writing 1 to 2 weeks out versus a year out. I mean, yes, you're going to get more premium up front, but of course, the only way that you'll be able to say write another one is if you say do a naked put, sell a naked put or something like that. You don't have cash secured put, or you decide to close it out and then restart and sell a year out. So the way that I like to look at it is it's a lot easier to manage risk when you're only looking 2 to 3 weeks out. So that's generally why I do 2 to 3 weeks out. I've tried doing, how do I say this? I've done 6-month and 1-year calls and stuff like that, covered calls in the past. And I feel like I had a lot less of an ability to measure success or consistent success. Whereas now when I'm doing 1 to 2 week calls or puts, I feel like I have a lot more success. So yeah, Uncle Dave got the new crib. Hopefully it's the new crib with 0 furniture. So so Paul Hearn, thanks for watching from the UK, man. Hopefully, I don't think I've seen you on the Passive Income Educator streaming channel, so links in the description. So make sure you're over there. We talk every Friday at like 10 a.m. So it's probably a little bit too early for you, but at least you can catch up the next morning because that'll obviously be like 3 a.m. for you. But yeah, it's 9 p.m. Central for me at that point, 10 p.m. Central, or sorry, 10 p.m. Eastern when we kind of kick off those streams. So it'll probably be like, yeah, like 3 a.m. for you over there in the UK. So, but if you're watching it the next with me, Uncle Kyle as well. So, oh, Uncle Dave's chiming in on the 1 month or 1 week to 2 year or whatever. But care about capital preservation. Oh, you're talking specifically. Yeah, okay. Yeah, you're talking specifically about not beating the market, but making sure you preserve your capital. The conversation I was having about Kevin O'Leary. Yeah, I think that's a really, really good discussion. I mean, it's not necessarily about beating the market. You know what I mean? Like it can be if that's what your objective is, but some people just need that income, right? Like a retiree doesn't care if he beats the market. The retiree cares that he's got the cash flow coming in every single month, right? So just like you, Uncle Dave, like you don't necessarily care in like the next 2-3 years when you hit that retirement date. You're like, I don't care if I beat the market. Like I need my drip. Like I need my like 4 or 5% coming in from the portfolio. Like you don't care if the portfolio value goes up 20% or down 20%. You just care that your dividends are going to be good and that they have a good safety rating and nobody's going to cut them. So like I completely understand what you're saying. But yeah, a lot of people liking the new place. So hopefully once I get things up and running in a couch and everything, because I'm currently just like sitting here with a bunch of like empty TV boxes and stuff like that, and hopefully get some paintings on the wall. It's a little bit empty, but the view is the best thing right now for the portfolio. That and my bed. I'm sleeping pretty damn good. So let's see. Yeah, me and Uncle Dave have been making some pretty good money. Tesla puts $5 or 5% probability of in the money expiration. Let's just see. John, welcome, dude. How you been? Sorry, I'm just scrolling down, so I just saw that you joined up. So that's awesome. Oh, we got Uncle Max being a dick. That's cool. Not a problem with me, man. How do you decide on duration of the put I'm selling? Oh, you're talking to Uncle Dave. Uncle Dave never goes 7 days out, man. Uncle Dave is a real conservative guy. So, yeah, we got Maxwell being a dick. It is what it is. Things move too much in Tesla. I agree 150%. So, uh, Uncle Dave out here schooling people. Uncle Dave, so I guess to give some context, so Dave, for those of you guys that are joining in now, I know we've had some people cycle in and out, but yeah, Dave is going to be nice enough. So Dave, remind me, I have to give you the StreamYard link for what we're going to be doing on Tuesday. But Dave is going to be kind enough to walk me and Kyle through kind of his strategy. I have my strategy, which mirrors similar to Dave's. So, Uncle Dave. So Dave is nice enough on Tuesday to kind of walk us through and walk. Kyle has a practice account set up. So hopefully the live examples will be really useful, but it's a private stream, so it's not going to be public. So if you guys want to be involved in that, you have to become a member of passiveincomeeducator.gov. And by .gov, I mean passiveincomeeducator.com. Let me do a quick link here and save it and send it in here. Kyle, I think, will be updating the link for you guys that are members, and you guys will get a link, and we'll have a list of all the private streams. So I think we're going to try to do one at least once a month right now, and I think in the future we're going to try to do them once every other week, if we can have good conversations like that. So instead of having like legitimate courses that you sign up for, it's more of like a, hey, whoever's a member can basically have any question and answer. So it's almost like a college class, right, where you kind of have two people giving an example, walking through examples, maybe giving some ideas as to what's going on, and teaching something. And then you'll have, I guess, the Q&A of any of the members that are curious about what's going on. So we'll be talking a lot about selling cash secured puts on Tuesday. We'll be talking a lot about selling covered calls on Tuesday as well, because Kyle is a little bit behind. So I'm just started getting into the swing of things as well with options. So I'm not by any means an expert, but yeah. So CDP is asking, he's got 100 grand in cash and he wants to invest. He doesn't own any stocks. What would I do with it? So I think it's all dependent on your 5 things, man. So I don't know how old you are. I don't know, don't know if you're 10, you're 20 years old, you're 40 years old. But at the end of the day, I think the easiest way for folks to potentially do well, and I think that I want to highlight this is something that I kind of stumbled upon the other day when I was chatting with folks, is if you pick individual stocks, you can get rich. But if you pick the right index funds, and I want to highlight the fact that I say the right index funds, you will get wealthy. I can guarantee that you will get wealthy. It will take more time, potentially, than picking individual stocks. But the example that I gave last Friday on our Friday stream on Passive Income Educator, so if you guys matched this, so apologies if some of you guys are listening in a second time on this particular topic. But the way I was kind of looking at it is, we're like, yeah, but if I pick the next Amazon or Apple, I'll be a millionaire in 10 years, or something like that, if I just put in $1,000. So imagine if I put in $10,000, I'll have $10 million. But let's just take a quick example. So VTI, which is the total stock market fund for Vanguard, invests in 3,500 companies, 500 of which are in the S&P 500. There's a couple hundred mid-cap, and then there's the Russell 2000, which is 2,000 smaller companies as well. So it's all encompassing in there. The probability of you choosing, let's say, the next Amazon or Apple or something like that is 1 in 3,500. Yes, okay, maybe you could say that's 10 in 3,500 because there's, one Amazon, there's one Apple, and yada, yada, yada. Okay, I can understand that. But is your ability to choose 35 out of 3,500, so like let's just say 1% of the next Amazon companies that kind of come on an IPO and have that ability to choose, 1%, let's just say, because let's be honest, I mean, there's 4 or 5 big companies that have kind of come out of, I guess, over the past 20, 30 years Granted, Apple's 37 years old at this point. Microsoft is like 40 years old at this point. But let's just say you have that ability and keen ability to choose that 1% stock that kind of comes in, and you're like, yep, this is the one out of, let's just say 3,500 that is going to go and get me a couple 1,000% returns. You can look at it that way. You can, in my opinion, that's gambling. I honestly think that you might have the ability to make some steady returns if you're able to look at financials and agree with the company's purpose and do well. Sorry, my battery was going low there, but yeah, it's a lot easier to guarantee yourself a 7 to 8% rate of return over time and consistently add capital to the portfolio. So if you're able to do that, you got 100 grand, you're 31, as you mentioned, you put it away, 7-8% return. Sometimes it might go down 10%, like it did, in March timeframe. But some months and some years it might go up 30%, like in 2015, or no, it wasn't 2015. Was it 2013? It went up 30% that year, like 30% in 1 year. And another time in 1995, it went up 30%. And you're just like, Jesus. So you're just kind of sitting in cash. You're losing money, man. Like you got inflation that's going to be turn into the equivalent of 98 grand next year. So I think that if you just have that ability to potentially invest in ETFs, the right ETFs and right index funds, I think you'll do great. And why I say the right index, right ETFs is because a lot of people are like, oh, I'll just invest in energy ETFs. Energy is down right now. I'll just invest in that. And I'm just like, yeah, but you're investing in so many crap companies. And same thing if you're investing in, say, consumer discretionary, and it's like you're investing in the good companies, but you're also investing in the bad. You invest in the S&P 500, they kick out all the bad companies. They have a bad quarter, they're out. So it's kind of like it's a passive way to invest in an actively managed sort of collection of companies, and that's beneficial. You make sure that they hit a certain criteria. If they don't, they're kicked out. So let's see what these lights do. Let's make a little show here. Let's make it a little bit better. Let's see. That makes it a little bit better. So yeah, I mean, and Uncle Dave, of course. I mean, if you have 100 grand, you can start selling some cash secured puts. You can make a couple $100 a month here, maybe a couple thousand if you kind of know what you're doing. But at the same time, there's risk associated with it. So it's all about what you want. Do you want more consistency? Do you want, I guess, income kind of coming from that money? So yeah, I honestly think it's going to be difficult to kind of start on someone on options, especially if you don't have a single stock to your name. So I'm a firm believer personally in just buying the right index funds and consistently adding capital every month. You obviously have a good savings rate unless you kind of came into that 100 grand. But I think that you probably have a good savings rate. So if you say you're saving 20% of your income, maybe more, 30% of your income, you're able to add that monthly to, say, the S&P 500, some QQQ, and maybe some QILD if you want a little bit of income. I think, man, you'll do really, really well. But yeah, Uncle Dave, he's trying to swing you down the options path, and I just feel like if you don't know what you're doing, if you listen to Dave and you follow kind of Dave's guidance, I think you'll do well. But I think sometimes, people will hear options, they'll listen to somebody, and then they'll kind of just say, oh, I'll just figure it out, I'll do my own thing. And then they end up hating the stock market forever. But it's like, if you listen to Dave, I listened to Dave and I ended up coming up with a pretty good, very similar strategy to Dave. I mostly just based off of what Dave was talking about, shorten my expiry times. I was doing my days to expiration. I was doing way too long of times. I was trying to sell way too close because I was more interested in trying to make as much money as I could. And unfortunately, anyway. So yeah, I know that's kind of a ramble, but I think that just investing in straight index funds, SPY, QQQ, will be really good for you in the long run. But yeah, and that doesn't mean that you can still sell cover calls, right? So Dave's talking about cash secured puts. You could also sell cover calls on that. So if you buy 100 shares of, say, the VTI or 100 shares of QQQ, you can sell covered calls on that and still generate more income, right? So anyway, hopefully that was helpful. But had a question here talking about how do you develop patience and consistency with investing in dividends for the first 2 to 3 years when you're seeing really slow growth. So don't necessarily know if you mean growth as in month over month income, or if you mean growth as in the dividend companies that you're investing in aren't necessarily getting the rate of return from a capital gains perspective that you were expecting. And so you're wondering and challenging yourself to see if investing in dividends are for you. So I would look again about what your objective is. If your objective is dividend income, then in all honesty, don't necessarily think about what the capital gains of the portfolio are. As long as you're investing in good quality, sustainable, dividend paying companies. But if your goal is to get your nest egg as big as possible, then why are you looking for dividends, right? So there's, in my opinion, there's a difference. Yes, they can be complementary, but at the same time, it's like, well, if you're looking for dividends, then why are you caring about capital gains? If you're caring about capital gains, why are you caring about dividends, right? Or if you want capital gains, then why are you concerned about dividends? So I think a lot of people get stuck in that loop. They say, well, I need dividends, but I'm not getting as much capital gains as I thought I would. So just touch back on what your objective is. Do you want the biggest nest egg? Because if you want the biggest nest egg, then maybe dividend growth investing isn't necessarily for you. You might be picking the wrong stocks. So, there's people, let's just say, that sit around for a 9 to 5 job that still can't choose the winners in the market, right? Companies are very dynamic. Things happen, political, environmental, and just like unforeseen sort of impacts to every single organization across the world, commodity prices, you name it, and it can impact how a company is operated. Poor management that you don't necessarily see. So you might see, let's just say, really good financials, but the management is kind of just like, let's just take all the money, put it in our own pockets, gives ourselves really good stock options, and kind of take that money out of the company, and we'll leave it for the next CEO. I see that a lot. We'll have the next team or somebody like pick up the slack. We'll kind of just like do our best. So, but anyway, so I think with some clarification on your question, it might help. But I think for me, understanding if you're looking specifically for dividends, then the consistency part of it comes when you add more capital to the portfolio, not if you just say put $10,000 away and hope that it compounds into say $1 million a year. I think a lot of it has to do with the fact that it's something that you work at. It's a mindset that you shift and you develop into. So you don't just invest one time or invest, let's just say, for 2 to 3 years and expect to become a millionaire. You have to work at the different mindset, right? It's like starting a business. It's like starting anything. It's like becoming a master at anything, right? Like you can't just invest one time and expect to immediately, be the best at it. You have to put in time. You have to put in diligence. And maybe the consistency and the time that you put in is very little time at all. But a lot of it has to do with the fact that a lot of people don't have a plan. So if you come up with the right plan, I think you'll do okay. But anyway, hopefully that was helpful. But if you give it a little bit more context, as if that then maybe I can dive a little bit deeper. But it's a pretty general statement, so it's hard to give a very specific answer to that. Let's see. So Uncle Dave out here schooling some folks. So once again, if you guys are interested, we're having a private stream with Uncle Dave. You can ask him all the questions live that you want. It'll probably be easier than typing, but of course you have to be a member of passiveincomeeducator.com. So if you do that, you'll get the private stream link here at the end of the day. Hopefully, I think Kyle's updating the link as we speak. So if you become a member, you'll get an email, and meet us up on Tuesday at 6 p.m. Mountain Time, 7 p.m. Central Time, or 8 p.m. Eastern Time, which is all the same time. It's just where we are in the world. Kyle's obviously East Coast, I'm Central, and Hot Dave is in Mountain Time. So we're all going to be meeting up on Tuesday. We're going to be chatting up on covered calls and cash secured puts. So hope to see you guys there. Let's see. Uncle Dave out here still preaching the cash secured puts and VYM. That's awesome. So, okay, so this is a direct question for me. So if you really want to own a few hundred shares of AT&T at $26 or $27, would it make sense to sell a year-long put versus a weekly, especially if it's likely to be assigned anyway? It's all dependent. I mean, if you really want to own the shares, then just buy the shares, right? But if you want to make money off of the, let's just say, premium, you're going to get more money selling multiple weeklies, right? So you're going to go out a week, it's going to change in price. But then again, the price could go up to say $30, right? And so you might say not have that opportunity to buy at 27 or 26, or say it goes, let's just say in the next month to say $31, and you're like, well, I really don't want to own it at $30, which is what you're not going to have to trade it as in order to kind of make that money on the cash secured put. So, I mean, if you really want to own it at say 26 or $27, yeah, for sure. I mean, that guarantees that you get that premium, you know, for a month or a year. But at the same time, you know, you might have the opportunity to, let's just say, sell multiple opportunities at say the $26, $27, several weeks worth of premiums rather. You know, it's really up to you. I mean, I've had more success doing the weeklies, but of course, I generally go 10 to 15% out of the money for some of these blue chip stocks, and I end up doing relatively well. So, I mean, it's really up to what you want to do. But if you really want to own it at 27, $26, then yeah, do a year-long put. I mean, I can't say that either one is wrong, right? But I think it's dependent on what your objective is. For me, you know, I wouldn't mind owning it at 27, $26 as well. I mean, I have one expiring, I think, this week for $27.50. And the reason why I did $27.50 is because, hey, I wouldn't mind owning another 100 shares of AT&T at $27.50. But I sold a weekly because I think next week it'll probably be $28, $29 range. And I think I could still sell $27.50 or a $28 call, or sorry, put the next week. And so I think it's just easy for me to kind of say that because I've had success being able to do that. But just because the price tag goes up to 30, $35 doesn't mean that you can't chase it, right? You might say, well, I don't want to buy it here, but I still want to sell, let's just say, the cash secured puts to get the income. You can still do that, you know what I mean? Like you could still say, well, it's going to be 5-10% chance of being in the money. I'll be able to collect, let's say, 20 cents worth of premium per share, so $20 a week. You know, $40 or $80 every month. Or you could just say, hey, I'll sell it for a $3, let's just say, option price for the whole year and kind of lock it in if you really wanted to. But think about that. If, let's say, you're able to sell it 20 times throughout the year at kind of 5%, 10% chance of being in the money, you know, for a cash secured put, you might be able to say double the amount of potentially double the amount of premium that you get over the course of a year. But of course, that's assuming that nothing is going to happen with the stock, right? So it's all about what works for you, man. I mean, nobody can tell you what to do. But I'm with Dave on this one. I've done leaps before, and I've just end up screwing up, right? And it just ends up not going my direction. But I feel like with weeklies, you can kind of manage risk a little bit better than if you have yearly options. So many things can happen in a year that, you know, within a week, yeah, things can happen, but how much does the stock really move over the course of a week? You can see a stock channel, let's say from a month time period, 30%, let's say, like we saw back in March. But generally speaking, the single day movements of 20% or more are very rare. They do happen, you know, of course, with every earnings season. I'm sure we'll see one, you know, in this upcoming earnings season, which starts on Tuesday. But I think it's a lot more manageable to manage risk and kind of highlight the fact that, you know, those things are kind of built in. But anyway, that's just kind of my opinion. But Hot Dave would probably agree with me there. So Matthew, I don't know if you're referring to options, or I don't know if you're so you're saying where should one begin to even start in this area? I don't know if you're talking about investing in general, options, any sort of, I guess, specific question that you might have instead of using general, I guess, questions would be really helpful to be able to help kind of kickstart the discussion for you. So Uncle Dave, man, this is straight up just talking. I love it. What's my lifetime stock? Hmm. Let's see. I don't think Wells Fargo is going anywhere. I like Wells Fargo. A lot of people don't like it, Dave included. I'm a personal fan. I think it's going to be perfectly fine. But I think secondarily, Johnson & Johnson will be a lifetime stock of mine. Oh, realty, unless something changes with real estate, maybe I want to buy physical real estate. Maybe I will sell it to be able to buy physical real estate, but I really like O Realty as well. And there's another one that I was going to say. I think MO is one as well. So MO, I think, is a good one as well. Let's just see. Yeah, so yeah, I would never sell MO. I think MO is great. They're transitioning to a smokeless future as well, which is more sustainable, I think, and safer for the consumer. But also when things get legalized in the States for with respect to MJ, I think that it's just gonna be gangbusters for MO, and I think they have the logistics already down. I was having a conversation with a buddy last night, actually over some beers, and we were talking, and I said, I don't. He was asking me, potentially about potentially getting into, let's just say, smoke shops or something like that for potential growth or something like that, and making some side income, and I was just like, well, I don't know if I would want to do that because I think that Altria Group and Philip Morris and those kind of companies will have everything ready to kind of go. They have the logistics, they have the fields, they have everything kind of ready in case of a federal legalization of MJ. And I was like, and so investing in these small companies doesn't make sense. They don't have the sort of infrastructure that in logistics already set up that like MO would have. And I was like, and plus MO is lobbying every day with the U.S. government about this. So then they made the comeback that, who's to say that they won't make you buy it from a, let's say, federally or not federally, but state facility, right? So think of like in Pennsylvania, if you live in Pennsylvania or even Texas, you have to buy from a liquor store. You can't go to, say, a 7-Eleven and buy. So there's still an opportunity to say have a smoke shop that would be, let's just say, state regulated but owned by you, and you would obviously still have the opportunity to sell, I guess, select brands or select, what have you. But I just think that you still look at it. Microbreweries do make some good money, but at the same time, who's making the most? And it's InBev. It's the big guys, Coors Light, Anheuser-Busch, which is owned by InBev, and Miller Coors, and those guys. They're the ones making the big money. And I think that's just because they make a generic product that is mass appealed. And I think that MJ, I feel like, will do the same. I think, yes, you'll have your craft buds, you'll have your craft sort of people that are into that, but just like breweries, I mean, there's craft breweries, and I still think that the people that make the most money are the Anheuser-Busch's of the world and stuff like that. So, but yeah, so I haven't mentioned in a second or so, but we do streams all the time. So if you guys are like, oh wow, Matt hasn't streamed in a while, we stream every Friday. So make sure you go over to our secondary channel. The link is in the description, and I'll kind of just copy it over here as well, so you guys have it. So I'm just going to post it in the chat group there. So if you guys haven't subscribed to that channel, feel free. What I'm posting there is the one that we had this last Friday. So there's some snippets of what we kind of talked about today in there already. So I'm kind of repeating myself a little bit. So apologies for those guys. But yeah, I love doing that secondary channel, man, with Kyle. That ends up being a good talk. Hot Dave's been coming on the past couple months, and we end up having pillow talk after. So it's a real good time. So let's talk. Uncle Dave's still schooling some people. CDP. You're asking a lot of questions. I like it, but we need to get you invested in the right stuff, man. Um, I wouldn't look specifically at stocks, especially with yourself not having. So I wouldn't look specifically at what stocks specifically to buy. I would look at index funds, and I would write that down. And I would probably just say, depending on how much time that you want to actually dedicate to investing in the markets, it's most likely best. So I have this conversation with a lot of friends, people that ask a lot of similar questions to you, and I love your enthusiasm, and I encourage that enthusiasm. And in fact, I would love to get you in the WhatsApp group. So make sure you message me, and we'll figure out a way to get you in the WhatsApp group, my guy. But I think what ends up happening is you see these spurts of enthusiasm. You know what I mean? And that's not a bad thing. You know, it's not a right or wrong thing. But I think what ends up happening is you stumble upon a stream like this, you get really imped, and then the next week or two you forget all about it. You know, because it's a muscle that you have to train and you have to learn. And you know, especially with a lot of things that you're not really familiar with, you know, potentially you're going to walk away from this, you'll retain 10, 20% of what we said, and you'll forget the other 70, 80%, and maybe 90%. And that's okay. And I understand. I mean, we've been doing this for years, right? So coming into this blind is difficult to do. But obviously, the thing that I recommend most is probably just to invest in, you know, individual index funds. Because I wouldn't say ETFs, Paul. I do like ETFs, and obviously when you invest in index funds, you're investing in ETFs. But the thing about ETFs is anybody can create an ETF, and you know, a Leary funds is a good idea, is a good example that you know, I can create an ETF, right? And it could have any sort of prospectus and have a management fee, and it's about investing in the right index funds, the right ETFs. A lot of people like sector ETFs, and I think that sector ETFs should be utilized in the portfolio with moderation. So, but anyway, I think most people don't have the time to dedicate, and honestly, they, instead of trying to be the next, pick the next Amazon or Apple, they just probably need to invest in the right ETFs. So yeah, if you're seeking dividends, Dave just said some really good ones: VYM, DGROW, SCHD. I'm still not a fan of SPHD. I prefer SCHD. VYM is a really good one as well. I've actually thought about doing that one, but I'd rather just kind of focus on the growth and the ETF aspect of the portfolio. But maybe in the future, if I say get too consumed with something else like websites or real estate, maybe I'll sell some of do similar to what maybe Dave is doing. I like what Dave is doing. I think he's a model for somebody that's just like, you know what, sometimes these portfolios and keeping track of some of these companies is too much. And I can understand that. I've been doing it, you know, for 7, 8 years at this point. And Dave's just like, I'm just going VYM. And I'm like, oh, that's actually a pretty damn good idea. And it's part of the reason why I started doing ITOT, QQQ, and QYLD. I'm just like, you know what, put it on autopilot. Still can contribute, but at the same time, anyway, there's that aspect of things. Is it 7:40? Wow. So I'm going a little bit. Let's just see. So yeah, I personally would look at, you know, my dream, like if I were to say start from scratch again, I didn't have the worries about volatility about my 9 to 5 or anything like that. What I would do is I would invest every penny that I own into a combination of like a total stock market fund or an S&P 500 fund with low maintenance costs, and a NASDAQ fund, whether it's NASDAQ entirety, NASDAQ 100, and maybe a secondary, say like dividend ETF, like a VYM is good, or something like that. But I would mostly put the highest part of the allocation into, say, those. But I just am a junkie for picking individual stocks, and I just can't do well at that, right? Like I pick energy stocks, right? And energy has not been good to your boy. So, and I think a lot of it is my bias. So, you know, I do well picking industrial companies and healthcare companies, but I think I just get blinded by the energy companies as I just work for the industry. So, unfortunately, so. But yes, please, if you guys are joining in, we're up to 41 folks again. Make sure you subscribe to the secondary channel where we do live streams every week. We have Hot Dave on. So if you guys are interested about asking options or anything like that, we have Hot Dave on there every week. At this point, I should just resign from having that secondary channel. Just give it to Hot Dave. Like, I love having Dave on, man. Him and Kyle have really good conversations, and I just like sit back and watch. I should like next time they just get in one of their conversations, I should just keep listening because I listen to them pretty intently, and I should just go like down to the pool, get some steak on the grill and just like add in everything like once in a while. That's kind of what I do, but instead I'm just staring at the screen, nodding my head like an idiot. I should do something productive, like pour myself a drink. You know what I mean? Like have a good old time. And I don't mind it. Like they always have a good conversation, so like I don't want to ever interrupt. But when I feel like I do need to, I kind of interject, give my point. But they just like they're really good about talking back and forth. So anyway, let's just see here. Missed a few. Have done any analysis on annualized return of capital on my options income? What delta is finding by the sweet spot? Playing conservative cover calls only. Cash secured puts, wheel. Hot Dave is the man. Everyone's going to ask about Hot Dave. So Tom, we're going to be having a private stream here on Tuesday with Hot Dave as well as Kyle, and we're going to be talking Hot Kyle through being able to set up and get him on this, because I think he's seen some of the income I've been making. He's obviously seen some of the income that Hot Dave's been making, and I think he's getting a little jealous. So we're going to do a private stream. So if you haven't already become a member, I'm trying to remember if you are or not. A link should be getting sent out here pretty soon from Kyle, and we'll be able to potentially answer any questions you have on Tuesday. But I generally look for 10 to 15% out of the current strike price, either direction, about a week and a half out, and that's been pretty good for me. But what I've been doing a little bit more is pulling up Robinhood. Now that I'm in the States again, so Fidelity, I like had it. So I have it like double secure. So whenever I have to log in, I have to log in with my phone, get a text message, and all that stuff. So that's just for security reasons. But yeah, so now that I'm back in the States, I have access to my US, account and phone number all the time. Whereas before I was using like a Trinidad cell phone when I was in Trinidad. So now that I have that, I can like look up and do options sort of analysis in Fidelity, which is nice. Before I was kind of using Robinhood, which just kind of gives you a percentage, right? Like, oh, it's probably 5% likelihood of expiring in the money based off the probabilities and the volatility and all that. So anyway. Haven't done an annualized return on capital yet. To be honest, I haven't really been keeping track of how much, let's just say, I'm putting up like every time. Generally speaking, I'm aiming for like 10 to 20% return on my money. Sometimes I'll do as low as like 7%. But the way I look at it is like 7% is way better than if that money were to be sitting in a bank, right? So. But anyway, yeah, the Tesla ones are easily 10 to 20%, and they're still only like 5% likelihood of being in the money. So, but yeah, I don't do. Sorry, I should mention that. So on the blue chip stocks is what I do 10 to 15%. Tesla, I do way further than 10 to 15% out for a week because it is a lot more volatile. So the wingspan of what you're looking at as a percentage out of the money or plus or minus out of the money, depending on if you're looking at covered calls or just calls in general, and selling puts is way larger for, I think, Beyond Meat even that I just did. So just because of the volatility, the IV of those, I think I just had to end up being way further out of the money. But most of the blue chip stocks have really low IV. So yeah, I generally can go 10, 15% out of the money and get whatever sort of money that I want for it, or a decent amount of money for it, which will be probably in the 5 to 10% rate of return range, annualized, right? Not so we're talking like less than 1%, right, of the total capital, and you do that, say, 20, 30 times a year. Let's just say it's generally what I do. I don't assume I'm going to be able to execute it, let's say, every week, right? I don't multiply it by 52%. So I don't get like 0.4%, let's just say, on a share price and be like, oh, I'm going to be able to do that 52 times in a year. You know what I mean? But you know what I mean in that respect. So like, let's just do a quick math. So like, I know I was hitting like 0.4% on something, but let's just multiply that. But yeah, like I don't expect I'm going to be at 21% on everything. But if I sell it for 0.4, let's just say I do it 25 times, I'll be able to get 10% return, right? So, but let's just think like 28 bucks. Let's just say 2,800. What was I kind of looking at? Yeah, I was getting like 10, 11 bucks, I think, per contract that I was looking at for AT&T. In fact, actually, I think I sold one for 30 bucks as well. So I was like, yeah, like 10 to 15 bucks per contract. I'm like, yeah, you're able to pull that off 30 times a year. Like we're looking pretty good. Like I'd take that 2,800 bucks and it'd be in a savings account earning me like 0.8%, 0.6% right now. So anyway. Let's see. Plus, you get to capture more capital appreciation. Yeah. Yep. Annualized, mean 10 50%. Yeah, 10 to 15%. So 15% on Johnson Johnson's a little tougher. It's a little bit less volatile though, right? So I think, for example, I don't remember off the top of my head, and I don't want to crash the stream because I'm still working off my phone. But I think Johnson & Johnson closed at 148 this past week, and I think I sold it for 160. So that's less than 10%. So I think that's like 7%. But if it goes to 160, it's above the 52-week high. So I was like, you know what? If it's above 52-week high and within a week, I really can't be that upset. So cool. Yeah, so the view looks pretty good. I want to eventually, you can see there's cardboard all over the floor. So let me like move. You can see there's like, I got a new TV and everything. So like I'm still getting settled, right? And I was like, I've been looking for couches, man. This is like a stupid conversation point, but I just like want to vent for a second. So like I've been looking for couches. So things I want. Outdoor furniture. There's a nice balcony out here. It's like way big. Like I think I might get a table out there, have like my table that I had in Trinidad. Like I have lunch outside sometimes and just be able to like be outside, in air conditioning. Sometimes you need a little heat, warm up your bones a little bit, then go back in, finish the rest of your workday. And then I have like 2 chairs that I'd have to smoke my cigars, and that's where I would like, line with the chicks and just like hang out with the chicks and just like have good conversation while the river was running by. Feel like I could do the same here if I had any friends over, guys or girls. The guys smoke a cigar, have cigar talk, pillow talk if Dave is here. Chicks are here, you have some drinks, you kind of move the chairs, chat a little bit, get a little close, have that good kind of conversation. So I'm obviously looking for outdoor furniture, but I haven't found something that I like with the price point that I want. I don't want to bust the bank, and I don't want to just buy something. Couch is obviously something I need to get. Coffee table, probably. Whatchamacallit, TV stand that I want, and a desk. And those are the key things that I want. In order of importance, I would say desk is number 1, couch probably number 2, number 3 is outdoor furniture for me. But it is what it is. So, yeah, Uncle Dave, man, give me good words of advice. Dave, thinking about going to Jamaica in November. What are you doing, man? You got open middle of November. What are you doing? You want to go to Jamaica? I think my buddy and I are going to Jamaica, so let me know. But mount the TV on the wall. I don't make that Rolls Royce money like Uncle Dave. But no, I've thought about putting the TV on the wall. I don't know. It's a 70-inch. We'll see, man. I've never had a TV mounted on the wall, so anyway, I'll have to have Hot Dave come down and hook me up, help me hang that TV. You know what I mean? But yeah, so I think I'm gonna wind this down. I'm gonna go. Actually, while I'm chatting, I'll wait for some final questions, and hopefully we can wind this kind of down. I'll pull out a steak here out of the fridge real quick. Or did he still frozen? Shit. That's bacon. What about these sausages? Oh, they're still a little frozen. This chicken's a little frozen still. All right, looking like hot dog and a burger. That's fine with me. Let's get the burgers out. Get them a little bit frosty, you know what I mean? And I gotta have some broccoli, or my friend in Trinidad is gonna kill me because I ate too much meat but not enough veggies. You know what I mean? So what other questions we got, guys? Pull that out. Oh, sorry, CDP. Yeah, I've seen him ask that question 3 different times, so I apologize. I was just like, yeah, I'll mention that right after I say this. Yes, this video will be. Sometimes it takes a little bit of an hour or two to render, so it should be available. I think it's public. I think I have it as public, so a little bit. And of course, yeah, man, message me on Instagram. So anybody that's curious, we do. Yeah, I feel bad, man. I feel like I'm not ignoring you, guy. I feel bad. I like watched it. And I was like, or you've seen me write it 3 times. But yeah, I'm on Instagram, of course. So if you guys have questions, I do have all my trades and stuff up on there anytime I make a big position. So if you guys were following me last week or 2 weeks ago, you would have saw I bought Palantir. You see every trade I make with Tesla, the cash secured puts that I make with Tesla. You saw the cash secured puts I did on Beyond Meat. So all that stuff, kind of there for the taking. And you kind of see me in my life as well. You get some updates about the apartment and all that stuff. And I'm a stupid. Oh my God, talking about Wawa. Jesus, I would agree. I fucking miss Wawa, man. That's one thing I might regret. Well, so I was back home visiting parents for like a day because I didn't want to spend too much time. Like I away from afar. We had dinner, but I didn't want to like give hugs and kisses and stuff because like I didn't know, coming back to the States what the beer virus was all about, right? So once I get everything settled here at the apartment, I'll go back and visit them for a little bit. But yeah, like part of me was just like I had like a day or two, and I was just like, should I just go to Wawa real quick? Like a Wawa hoagie would be real good right now, but I did not. But so yeah, Lord Slade, sorry, I saw you mention that one as well. Talk a little bit about QYLD. So I will reserve the questions about QYLD to my boy Jerry at GW Investing TV. He's my guy with ETFs, and he's doing really well. So yeah, CDP, thank you. I love doing these streams too, man. Me and Hot Dave, we do these every Friday on our other channel. So Dave's basically part of it at this point, but don't expect any equity, Dave, or at least you're gonna have to pay to get some of the equity on copy link, yeah. On Passive Income Educator. No, I'm just messing around, but Dave is always on there. He always shows up, 15 to 30 minutes before we end things. Me and Hot Kyle generally just shoot the shit, and then we were eventually like, yeah, who's got questions? And then Dave's like, I'm on. Yeah, I mean, Dave sings me to sleep after the streams. So, I mean, after everyone goes to sleep and the stream, gets off of live, Dave pulls out his guitar and serenades me. And, I start getting droopy on the eyes. So, yeah. But yeah, so CDP, message me on Instagram. We'll get you in the WhatsApp group, my guy. That goes for anybody. Message me on Instagram, message me. We'll get you in the WhatsApp group. You can chat with us all the time. And of course, if there's any final questions, I'll take them. But it looks like it's kind of winding down here. Appreciate everybody kind of doing it. Seeing this, I guess, the apartment for the first time, which is kind of chill. And glad that I didn't lag out because on Friday I was lagging out bad. I don't know why I was lagging out so bad on Friday, but 41 of you guys still in here. Really appreciate that. It was a real impromptu stream like I always used to do. And so I'm gonna take some of these burgers and hot dogs and maybe some broccoli and head down to the pool and grill some stuff up. And I'll catch you guys on the next stream. If you guys are interested, we're having a guy on Tuesday. So Dave, before I leave, I'll send you that link. I think I'll do it on Instagram. I think that might be the best place to send it to you. And yeah, man, I'll see you guys soon. Hopefully over the coming weeks, you'll see on Fridays, you'll get more paintings, you'll get, some furniture. So hopefully we see the set kind of expand. And I really like this ring light as well. So hopefully you guys can see my face a little bit better. It looks a little bit better. and the audio quality is a lot better. So if the audio quality, if you're listening to this back, the audio quality is better, let me know in the comments section down below, because I've been hearing about it for 3.5 years, how horrible my audio quality is. So if the audio quality is a little bit better, then just let me know. Give me a little like smoochy smooch. Give me a little subby sub. Give me a little likey like or dislike. I don't give a shit. Just like do something. Let me know, so that way I know what that things are going in the right direction. So, all right, guys. Check you on the next video. Don't do anything I wouldn't do, and I've done some shit. Cheers.